Three, two, one. Don't smile, Ben. Go.
Good morning. Today is Tuesday, April 19th. Tomorrow is Wednesday, April 20th. So that is when Tesla is reporting earnings. So that's an easy way to remember what date it is. But we're going to actually start off not with earnings. We will hit that later in the program, but we're actually going to start off with Jim Bullard. He's obviously the member of the Federal Reserve. He has been the most hawkish member of the Federal Reserve, which means that he is wanting to raise the interest rates faster than most others. And he was interviewed yesterday, and he said he does not rule out a 75 basis point increase in May. Again, they're meeting on May 4th. He says that it's not his base case, but he doesn't rule that out. And he calls for interest rates to finish the year at 3.5%. This would imply a total of 14 rate hikes. Even the market, which is pricing in a fairly aggressive path of Fed hikes, it's only pricing in 9.6 rate hikes over the balance of the year. So the 14 that Bullard is promising seems a little bit aggressive. What is your opinion of this, Tom? And do you think that 14 might happen?
I think that it's certainly possible. And I think it depends on how the internal discussions go in the Fed. And I think that, like any group situation, there's going to be outliers in terms of opinion. And I think Jim Bullard is probably going to be the furthest to one side in terms of the hawkishness scale. And so my expectation is if he's saying we need 75, we're probably going to land on 50. And the reason being that if he's the most extreme, there's probably going to be some people in there who are arguing for a quarter point. And of course, in a group setting, compromise would be 50 basis points. And so if you look at the futures now, we've actually seen zero change since this came out. A lot of times this year when we've had somebody of note come out and say something and have a strong opinion on how many rate hikes are going to be, we've seen some movement in futures. But right now, we're really locked in. We haven't moved at all this week in terms of how many rate hikes are implied through futures for May. We're right at, it's like 96% chance we're going to get a double hike. So we're going to be at 75 basis points after this meeting. And one thing that I thought was interesting that he said is that he said that the Fed is facing a credibility crisis, which is something we started saying probably back last summer. And it's like almost like everything that should have been done is on a 6-month delay. We should have probably started tapering back in the summer. We should have raised interest rates before the end of last year. And the Fed was in a credibility crisis last summer, but now they're basically coming around saying, hey, we might have a problem with our credibility, which I think a lot of people are saying and have been saying for some time. So the question is, how aggressive can they be? I mean, they really need to attack this thing. But the question is, can the market withstand it? I'm interested to hear your thoughts, Ben, given the fact that would be a market increase, especially if we got a 75 basis point rate hike, how does that affect valuations in your mind? And do you think the stock market could potentially see some wild gyrations from that?
On the stock market side, I think that we're seeing some normalizing there. And I think the reason for that is we're seeing the curve steepen. So we're seeing the 10-year interest rate and the 30-year interest rate actually go up. And it has actually increased faster than the short end in recent weeks. And I think that does give the Fed more cover to raise rates a little bit more aggressively because you want to stay out of that dreaded curve inversion. And I think that's one of the things that the stock market's nervous about. But we were talking about this before as we were just kind of convening before we sat down here today. And I do think that at some point, the Fed is going to have to address the liquidity in the market or lack thereof. Because right now, if you look in taxable municipal bond land, if you look in mortgages, you're seeing some pretty significant dislocations. We're looking at the mortgage spread versus the 30-year Treasury yesterday, and we're about as high as we've ever have been. And that includes 2008, that includes 2020. And so we're seeing spreads really dramatically widen out. And if the Fed wants to maintain that liquidity in the market, it's going to have to address those pockets. I do think that fixed income buyers will come in at some point and stabilize those markets. But it's tough right now because so much is driven by ETFs. If you look at BlackRock's conference call, they're all going into ETFs right now, including large pension funds. AIG just signed up with BlackRock to manage its $150 billion portfolio. So what this means is that you're not programmatically trying to identify areas of opportunity in the fixed income market, which leads to more inefficiency in the market. And I think that would be the most concerning thing, because And I think that would be what impacts the stock market. So can the Fed maintain liquidity in the market? I think that's more important than necessarily just raising rates, because I think right now the liquidity issue is more important than just raising rates.
Yeah, I would agree with that. I mean, if you look at chart of the spreads of mortgage backs over treasuries, the last time we were this high was when the bond market broke down in March of 2020. We're actually a little bit higher than that as of this morning. So, in terms of the liquidity in the municipal bond or the mortgage-backed security space, I mean, we basically have nobody buying. There's zero liquidity there. You probably couldn't sell what you have, and you're not going to want to buy what's out there. Which is a really, really big change from where we were even 6 months ago. So that's something that is concerning, but I think it creates opportunity. I mean, taxable bonds, taxable munis, to your point, are down 12.5% this year compared to the bond market at large, which is really only down, call it 8% for taxable bonds in the AGG. So, I mean, that's a serious movement away from where we were last year, where taxable munis were trading at extremely low spreads historically. So again, stuff that's ultra high credit quality, backed by, municipal governments, is now getting absolutely crushed, which creates opportunity, especially with all the upgrades we've seen. But unfortunately, taxable munis are the bulk of the bonds we hold within IRAs, because they're so safe and because they're so clean. But the pricing on them has been just a runaway. And so we need to continue to hammer that space while the opportunity is there. But definitely recognize the fact that there's not a ton of liquidity as well.
In concert with that, we've actually seen a significant strengthening of the US dollar over the last few weeks. It's strengthened significantly against the euro, but it's really strengthened against the Japanese yen. The Japanese yen has, it was 115 to the dollar, and now it's 128 to the dollar. Today is the 13th consecutive day of devaluation. That's the most since 1971. The Japanese yen is now the weakest since 2002. And basically what this is saying is that if you do business in Japan, you are getting devalued right now in terms of that. Now, if you're exporting from Japan, you're probably doing fairly well because your cost base is in Japanese yen. So think of some of the auto manufacturers. Honda should be doing well, for instance. Toyota should be doing well. But if you sell a lot into Japan, that's going to be an issue. So companies like Aflac, where a large majority of its business is actually in Japan, that's going to be offset a little bit because of higher reinvestment rates in their fixed income portfolio. But nevertheless, that is something to watch, and I'm certainly curious what the impact that has as we look into earnings season. Moving on, we did have some good news yesterday. The mask mandate was overturned by a Florida judge in Tampa, and very quickly. And I was actually seeing tweets about this from an airplane where the pilot said, you know what? They just took off the mandate. Our airline is taking off the mask mandate, and everyone took off their masks and took pictures on the plane. It was kind of a cool thing. So now for domestic flights on pretty much any airline, I think Spirit might be not doing it right now, but American Airlines, Alaska, Delta, Southwest, United, even JetBlue, they've all dropped immediately their mask mandates for both in the planes and in the terminal. So that's good news. The question is, does this result in less travel demand because people are concerned about getting COVID, or does it result in more travel demand, or does it just not have any effect, Tom?
I mean, I think it depends on where you sit in terms of COVID. I mean, I think it benefits Atlanta specifically because, demographically speaking, I imagine there are a lot fewer mask wearers in Atlanta, and we just happen to have the busiest airport. So if you weren't going to the airport and you live in Atlanta, you might now go to the airport because you don't have to wear a mask. I mean, I can tell you when we flew out to Colorado a couple weeks ago, that was the worst, having to sit on a plane for 6 hours in a mask. I think Andrew would tell you that at one point the flight attendant asked him to wake up the person next to him and tell her to put her mask on. And I think he was like, nah, it's definitely not my job. So I think it's net benefit. I think it's going to get more people going than not going. I think anyone who was having to fly anyway was probably either on board with the masks or, reluctant to do it. So I think that those people who are reluctant to do it and were not flying, I think you're going to jump in. Whereas we didn't have that before, but it'd be interesting to see. I mean, we'll see the numbers play out probably the next quarter to see, is travel demand higher now that you don't have to wear a mask, and perhaps car rentals will be much lower because people, would rather drive 3 hours to the beach than, try and fly.
I think we are seeing the negative impact. I think the most salient issue for a lot of travelers right now, at least in surveys and anecdotally, seems to be the cost people are definitely having a sticker shock when they look at flight prices right now. And I think that might be the biggest impediment to more travel, but that's not necessarily bad for the airlines. I mean, if the airlines wanted more demand, now they can go back to their more fundamental supply demand dynamics, and reduce prices to get more of those seats filled. But right now, the load factors are doing very well. They're filling the planes, and they're charging a lot for them. So the airlines are in a relatively good spot right here. Moving on to earnings, we did have JB Hunt come out with earnings last night. They had a solid quarter. So JB Hunt does a lot of logistics, asset light, which means that they don't have a ton of assets themselves. They're more of a broker in many respects. And they use railroads for a large portion of their business. They have a big agreement with Burlington Northern Santa Fe. And they just blew out the earnings results. They had extremely strong pricing in their trucking business, which is a small portion of their business, but pricing was up about 50% on a year-over-year basis. The intermodal business continues to enjoy pretty strong demand. They did talk about the decline in spot prices. So one of the things that we talked about at the macro presentation was that we are seeing a significant decline in trucking spot rates. But they said that as far as their contract demand goes, they're actually seeing very strong contract demand. And in fact, it's the strongest they've seen in the 27-year career. In addition to that, they ship a lot on railroads, which is half the cost of trucking. So if people are getting concerned about trucking prices, they're just switching to rail, which is a good thing for JB Hunt. So JB Hunt is up slightly pre-market. Well, it'll be interesting to see how that trades throughout the day. I'm surprised it's only up 1%, frankly. I thought it would be up a little bit more. We also got earnings from Johnson & Johnson. They completely removed their COVID vaccine guidance for the year, but they actually had some pretty good sales in the medical device segment. It looks like surgeries are really picking up. Tom, I'm curious, do you have any perspective on the surgeries? It seems like, especially on the orthopedic side, seems like people are finally getting their knees done, their hips done. Those posted some of the best comps that I've seen for quite some time during COVID or even before COVID.
Yeah, I think that really just a month ago, the entire scenario changed. And I think that probably pushed a lot of people who were maybe hesitant to be in a hospital for any reason towards that, getting knee surgery, getting cosmetic surgery. There seems to be a huge demand that's pent up there. I think that's very beneficial for Johnson & Johnson, and maybe even, knock-on effect of some of the smaller device companies like Stryker or Hanger, some of these companies that have really struggled because they haven't been able to have those implants put in because there are no, elective surgeries going on. So that's definitely something to watch. But I think that, we don't hear every day on the news that all the hospital beds are full. Everybody's getting COVID in the hospitals. You just don't hear that stuff anymore. And I think that makes people feel far more comfortable going in and getting work done.
Yep. And then finally, Lockheed Martin actually had a rough quarter. They underperformed in pretty much every business segment. They're just going through a period where defense spending is moderating a bit. And I know we see the headlines, but this is a great case study in not following the news of the day, because it's not like after a month and a half of war between Russia and Ukraine, you're going to see a dramatic shift in terms of Lockheed Martin's earnings profile. It's just a bigger ship to turn, and it requires more planned spending. So Lockheed is actually down pre-market. They had some unfavorable profit adjustments, and especially in their Sikorsky business, which is their helicopter business, they underperformed a bit. So we're continuing to watch that, but it is an interesting case study in not following the tail of the day. Similar story for Halliburton. Halliburton, a huge oil field servicer, they had nothing but good things to say about the market. But at this point, everyone expects that things turn on a dime, and that's just not the case. So Halliburton was down a little bit pre-market. I think ultimately it'll continue to go up, but it's just not going to respond in a month and a half to higher energy prices. Tom, anything else to add before we close?
Not that I can think of. I'm very happy with the JB Hunt news. We had Kevin Donahoe, our intern for the spring. He did a lot of work putting together the pitch for JB Hunt. And, the ultimate decision was that it was probably too expensive to buy. And it's just been in a free fall ever since he pitched it. And so I think this positive earnings report is really a backstop saying, hey, the tide is turning here. Let's reassess the valuation. And it might be a really good opportunity to get in because it's significantly lower. Even if it's up, 1% today, it's probably down 20% in the last 3 weeks. So I think it gives us a nice entry point into the trucking business, which we don't have a ton of exposure to.
And it's important to retain perspective on things like that. When we accumulate a position, we don't accumulate a large position overnight. To the extent that we accumulate a position, it tends to take 3 to 6 months. And we'll gradually try to take advantage of opportunities as they present themselves. And that's what we're going to do with JB Hunt. So I think this will actually be a pretty good setup for us over the long term on that stock. So with that, we'll close it there. We'll see you here tomorrow. I think Andrew will be back, and have a great day.